The Fed raised rates again. Now what? Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. If you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. Okay, so I am a cyclical and seasonal trend trader. To me, this approach just makes sense, and it's one of the easiest, most predictable ways to make money in the markets. Now, there are small individual company trends like the way a company's shares will move on earnings. There are broader trends like the changing of the seasons and how that impacts consumer buying habits. You know, that they alter in each one.
Well, you know what? At least the weather's turned.
Oh, sweater weather.
Sweater weather.
Sweater weather.
Oh, God, I was...
Finally, sweater weather. Sweater weather.
It's about time.
It's about time.
Sweater weather.
Sweater weather.
Oh,
Finally, sweater weather.
God, sweater weather.
Sweater weather.
And then there are these large macroeconomic trends like the Federal Reserve raising rates. Well, all of these you can exploit by buying when pessimism is high, like we have now, especially when you know the mood is going to change. If you tune into the mainstream financial media, there seems to be little to be optimistic about. It's one negative headline after another, and every tick lower on the S&P 500 gives even more reason to stoke fear. But I've always encouraged investors to turn a deaf ear to those outlets. Instead, I've advised unplugging from your television, or at the very least put it on mute. That's because the reality tends to be much rosier than the news wants us to believe. Take the Federal Reserve raising rates this past week. This was the largest rate increase since 2000. That's more than 2 decades. And investors have been whipped into a frenzy about how devastating a half-point rate hike might be, or a 0.75 might be in the cards, and how that was going to impact stocks. Now, all of this was being said despite the fact the cold, hard facts paint a very different picture.
We don't make mistakes. We have happy accidents.
All right? During the last 12 rate hike cycles, going all the way back to the 1950s, back to when Back to the Future took place, the S&P 500 has averaged an annualized return of 9%. All right, that's after those rate hike increases. Again, that's the average return of the S&P. Year-to-year increases tend to be much higher, or even kind of lower than that. Now, it's vital to remember the S&P 500 has been up 1 year after the first rate hike every single time, 100% of the time. And equally important, in only one of those rate hike cycles since 1950 is there an average negative return, and that's the cycle from 1972 to 1974. In those years, the S&P gained 15.6% in 1972, but it lost 17.4% in 1973 and 29.72% in 1974. That was the great market crash and recession of the 1970s. Well, let's be clear. That market downturn had nothing to do with the Fed and all to do with the collapse of Bretton Woods, the OPEC oil shock, as well as a number of decisions by President Richard Nixon, which were then known as the Nixon shock. It's worth noting that the market bottomed after Nixon was impeached and resigned in August 1974. Now, you might be saying to yourself, but this pullback and volatility in recent weeks has been scary. I know it hasn't been pleasant. You know, we did have the big jump on the Fed rate hike announcement. That was because it was a 0.5% increase instead of 0.75. So it was truly a relief rally. But let me tell you something most others won't, and that's this is perfectly normal.
This is fine. I'm okay with the events that are unfolding currently.
The facts are, during the last 4 rate hike cycles, the S&P has fallen an average of 3.8% after that initial increase. The Fed first raised rates this year on March 16th. The S&P pulled back nearly 3% since then, heading into the second rate hike, right? So all of this is par for the course. So don't get discouraged, don't get panicked, or don't get scared. This is a pattern that repeats itself over and over again, and you can profit from it. This is a cycle that has been going on for decades. Now, you want to know the reason why I'm a successful cyclical and trend trader? It's because people forget that we've seen these patterns before. They panic. And as long as you don't, that's your advantage. We know stocks snap back from this point and head higher. The first few months of a rate hike cycle are historically choppy, but then it's largely business as normal from there. Position yourself now while the discounts are still deep. And a year from now, 3 years from now, you won't regret it as your portfolio is full of gains. Okay, one of the best ways to profit from cycles and trends is to use options. You know, I've been doing this for myself and my subscribers for about 10 years, and I am one of the most award-winning strategists at the Oxford Club. Well, I've put all of that knowledge together in a brand new presentation called the Oxford Options Accelerator. I've provided a link below for you, so be sure to check that out. Well, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. Until next time, here's to high returns.